Okay, let's dive right into this. Welcome to The Explainer. Today, we're unpacking a truly fascinating equity research report on aerospace prime contractor Redwire Corporation. You might know them by their ticker symbol RDW. We're going to look directly at the data to decode exactly why this company is getting a very firm hold rating from analysts right now, even though they're sitting on some absolutely incredible technological breakthroughs. So here's the central paradox we're exploring today. How on earth can a company dominate its sector with explosive top-line growth, but at the exact same time trigger a mass exodus from its own institutional investors and attract a massive swarm of short sellers? It seems completely counterintuitive, right? I mean, if you've ever looked at a stock chart and thought, man, this makes absolutely no sense, well, this one is for sure for you. Let's look at the numbers driving this wild narrative. Take a look at this staggering figure. In the second quarter of 2026, Redwire reported a year-over-year consolidated revenue increase of 89.6%. That totals a record $117.1 million. On the surface, that is just incredible operational success. You'd think the market would be cheering and the stock would be flying high. But, well, if we dig just a little deeper into the income statement, the story gets way more complex. And this right here brilliantly illustrates the core issue. What the research actually shows is a severe dichotomy. Redwire is essentially two drastically different companies mashed together under one ticker symbol. On one side, we've got the new defense tech segment. This thing is operating like a speedboat. Hypergrowth, highly profitable, 22.8% EBITDA margins, and boasting a massive $220.2 million backlog. But then, on the exact opposite side, you have the legacy space segment. And that is acting like a heavy anchor, just dragging the whole boat down. It's suffering from contracting revenue, operating losses, and some pretty nasty liabilities tied up in legacy fixed-price contracts. Section 1. The Defense Tech Pivot. So let's start with the good news and focus on that speedboat. This entire pivot was actually catalyzed by a massive $925 million acquisition of a company called Edge Autonomy. That move fundamentally altered their financial profile and, get this, generated 103% of Redwire's consolidated top-line growth. Which brings us to their absolute crown jewel, the Stalker Block 30 uncrewed aerial system. The tactical advantages here are profound. We're talking flight times of over 8 hours using a proprietary solid oxide propane fuel cell. It's got vertical takeoff and landing capabilities, and it operates with a nearly silent acoustic signature. Crucially, it's on the Department of Defense's Blue UAS cleared list. That means it bypasses literally years of bureaucratic red tape for procurement. This is combat-proven tech. It's currently deployed in heavily contested electronic warfare environments over in Ukraine and is securing multi-year NATO contracts. All of this creates a remarkably deep competitive moat against their peers. Because of that overwhelming technological superiority, the defense tech segment is experiencing massive demand. Just look at this number. This is their book-to-bill ratio for the segment, 2.35x. Simply put, they are signing new contracts 2 1/3 times faster than they can actually fulfill them. For an investor, this isn't just some fun vanity metric. It provides incredible, rock-solid visibility into future cash flows, resulting in a highly scalable structural backlog. Section 2. Pioneering Space Innovation. Now, Redwire isn't just a drone company. Maintaining that high-energy, forward-looking operational view, they're actually positioning themselves as a monopoly player in next-generation orbital infrastructure. A huge part of this innovation is their laser focus on very low Earth orbit, or VLEO, which is that tricky altitude right between 150 and 300 kilometers above Earth. The advantages are obvious: lower latency for communications and way higher resolution imagery using much smaller optics. But there is a massive engineering hurdle at that altitude, and that's extreme atmospheric drag. Well, Redwire solves this with their SabreSat platform, using what's called air-breathing electric propulsion. This is wild. It literally harvests atmospheric oxygen to use as infinite propellant. It's basically the closest thing we have to a self-refueling space car. It completely eliminates the need for heavy onboard fuel tanks, and it's so revolutionary that DARPA actually awarded them a $44 million contract to build and demonstrate this tech in orbit. And if that wasn't futuristic enough for you, look at how they're disrupting the $280 billion biopharma market. Their pill box hardware crystallizes pharmaceutical compounds in microgravity. Because you don't have Earth's gravity driving convection, these crystals actually grow larger and much more uniformly. And that's absolutely critical for structure-based drug design. They've already successfully crystallized compounds for blue-chip clients like Eli Lilly. Now, their subsidiary SpaceMD has gone ahead and procured an entirely dedicated 2028 SpaceX Starfall mission. They're going to carry up to 32 of these units and bring those space-grown crystals right back down to Earth for next-gen drug manufacturing. Pretty incredible, right? Section 3, the dilution death spiral. So, we've got combat-proven drones, air-breathing satellites, and space-based biomanufacturing. Sounds like a guaranteed winner, doesn't it? Well, let's pull back the curtain. Operationally, yes, they are brilliant. But financially, they are burning cash at a severe rate. To fund their negative $35.3 million in free cash flow from Q2 2026, they rely heavily on this specific financial mechanism right here, the at-the-market or ATM offering. As defined, it allows a publicly traded company to raise capital by selling newly created shares directly into the open market at whatever the current price happens to be. Now, while this rapidly generates the cash Redwire desperately needs to survive and build out their facilities, it comes with a brutal side effect. It constantly, relentlessly dilutes the ownership percentage of existing shareholders. Now, what's really interesting about this timeline is the sheer scale of the dilution taking place. Back in December 2025, there were 191.9 million shares outstanding. Fast forward to the end of Q2 2026, literally just 6 months later, and that number skyrocketed to 249.2 million shares. Let that sink in. That is a staggering 29.9% dilution in just half a year, all as the company scrambled to generate over $566 million in liquidity simply to keep the lights on and keep operating. And sadly, the threat to shareholders is far from over. In June 2026, Redwire terminated their old program and announced a brand new $500 million ATM equity distribution program syndicated across 11 major banks. The kicker? Management retains full discretion over exactly when to issue these shares. So this effectively acts as a massive ceiling, capping any real upward stock price momentum. Anytime the stock starts to climb on good news, management can essentially just hit a print shares button to raise cash, which immediately squashes that momentum flat. This quote, straight from the research report, summarizes the pain for investors perfectly. While absolute revenue grew 89.6%, revenue per share collapsed by 23.0%. The company itself is getting much bigger, sure, but it's being sliced into so many tiny pieces that the individual investor is actually walking away with less. And compounding this pressure, their private equity sponsor, AE Industrial Partners, has been aggressively liquidating their massive position. When the smart money that backed the company starts rushing for the exit doors, it removes a major pillar of institutional support. That emboldens short sellers to bet against the stock, which is exactly why we're seeing a very heavy short interest of roughly 16%. Section 4, Sector Trends and Catalysts. Let's zoom out for a moment. The entire aerospace and defense sector is shifting rapidly toward proliferated autonomous architectures, things like the DoD's Replicator initiative, while simultaneously preparing for the decommissioning of the International Space Station by 2030. So the crucial point is, how do we actually value a company that is perfectly capitalizing on these trends, but is violently split between hypergrowth defense tech and cash-burning legacy space? This table compares Redwire against pure-play space peers like Rocket Lab and defense peers like AeroVironment. On a price-to-sales basis, Redwire trades at a 7.02x multiple. Now, that's a massive discount compared to Rocket Lab's 53x multiple, reflecting how the market is heavily penalizing Redwire for its cash burn and dilution. Yet, it actually trades at a premium to its defense peer AeroVironment, which sits at 4.09x. Why the premium there? Because the market is applying a sort of narrative hype premium to Redwire's VLEO satellite programs and their microgravity pharmaceutical potential. Now, the report does highlight several key future catalysts that could potentially shift these valuation scales. In the short term, you're going to want to watch the Q3 2026 earnings report this November. That'll be a vital check to see if they are actually converting that massive $542 million backlog into profitable revenue. Looking a bit farther down the road, keep an eye on the late 2027 launch of the Axiom commercial module that's powered by Redwire's deployable solar array wings. And of course, that massive late 2028 SpaceX Starfall mission, which could definitively validate the commercial viability of their space biomanufacturing. These milestones matter deeply for the company's long-term enterprise value. Section 5, the final verdict. All right, it's time to bring all these threads together. We've explored the incredible technological moats, and we've looked at the deeply toxic capital structure that's paying for them. Let's move to the analyst's final recommendation and see how all this builds to a firm hold. The justification presented here is that despite possessing absolutely incredible, moat-protected defense technologies and a record-breaking backlog, the near-term capital structure is just simply too toxic for capital appreciation right now. That relentless $500 million ATM overhang means that equity value is going to be constantly diluted just to fund operations. So the clear recommendation is that investors should remain on the sidelines, wait for management to pause this aggressive share issuance, and wait for free cash flow to finally inflect positively.
Which leaves us with the ultimate question as we wrap up today's explainer. Redwire is fundamentally a tale of two very different stories. Operational brilliance weighed down by a massive financial anchor. As we watch this company execute on its groundbreaking space and defense initiatives in the coming quarters, we have to ask, can Redwire's hypergrowth speedboat eventually outpace its massive dilution? Or will that ATM facility drain the tank before they ever reach true profitability? It's going to be a completely fascinating balance to watch unfold. Thanks for joining me on this explainer, and as always, keep learning.